One.
Hey everybody, good afternoon. This is 12-Minute Trading. My name is Doc Severson and I've got Dave Lukas here with us today. Today is Tuesday, the 5th of September after a great Labor Day weekend. Here we are back at it again today. Man, Dave, it's like, I don't know if you looked at the news this week, but this is probably one of the lamest weeks that I've ever seen on the calendar in terms of there's nothing, there's no market moving earnings that are happening this week.
Right.
There's no economic announcements. There's hardly any Fed speak. The Fed goes into quiet period this weekend. It's like we couldn't want better price action for what we do.
Well, there is Fed. I did see there's a number of Fed speakers this week, but I don't know if they're going to make much of a difference on anything. So we last week was lowest volume week of the year, so it's prone to big moves. We got the big move, we went up, but that's gone up and hit the upper Bollinger Bands on the charts. It's taken out a lot of that daily energy that was there that we were talking about, and so this week, like, I would expect to see a pretty decent pullback. Actually, that would be the easiest way to charge things back up and kind of finish charging the weekly chart back up. We just may not get it. We just may be in a malaise this week and just kind of like drift. We may not really go anywhere for the week. And that's we kind of saw that Friday too. We're watching it today, like the S&P. The SPX is not giving up 4,500, right? And it, like, we get down there, and then like last week and on Friday we were looking like we're going to, and they got bought back up right in the end of the day and went positive by a few points. And today's looking kind of like that same type of thing. Like, it's just it wants to go and give it up, but it just kind of it just doesn't have that spark. And so maybe something will come out this week in a week that doesn't have news, where we get some news, and that actually does it. We'll find out, but and we'll see what happens at the end of today. We're going into the final hour of the market. Maybe we do sell off, like we started the day. We'll see if that happens. But one thing I'm watching is oil. Oil hit $87 a barrel. It's chugging up toward 90. That's going to start to have an impact on the markets. Interest rates. I still think if we're going to get a surprise, it's going to come from the credit markets. It's going to come from something with the bonds and the treasuries in the long end of the curve. Everybody's like, bonds can't go any lower price wise. Well, maybe not. We'll find out. But with what Japan's doing and has to do, and what's going on in China and everything else, I still think there could be a surprise that comes out of that. So that's kind of how I'm kind of watching things and stuff. We know September is typically a down month, right? But we might have had the down month in August, and September could be up. We'll see. So there's just, it's going to be the unknown that either way that does it this month. That's just kind of where we're at.
I am going to bring up the charts here. Last week we talked about a Darvas box, right? So Last week we were talking about this Darvas box being back here on the S&P, and just about every chart had the same thing. It's like, and we were sitting here a week ago, well, actually, previous Monday, and going, okay, so if it breaks above here, that's bullish. If it breaks down, that's bearish. I know I got a couple of comments from people saying, well, duh, but that's the point here, is that you set up the box so that you frame whether or not you're going to be, most people spend their time trying to buy into predicting the future and saying, well, this is going to happen, so therefore, and they're 100% into that. And the problem is that most of the time they're wrong, and all of a sudden when they are wrong, they're not prepared for what happens there. So I'm always prepared whether or not the price is going to break through the top of the box or break down through the bottom of the box when you set up a Darvas box like this. So boom, we got the JOLTS report last week, blew right through it, because that implies that the Fed's going to be very, very close to being done. In fact, right now we have over a 90% chance of nothing happening on the 20th of September for the Fed meeting, which is good. And so there's only 2 Fed meetings left for the end of the year. So we're closing in on the Fed maybe being terminal. Okay, so as we look at this chart, we do have a daily exhaustion figure here. So range expansion went so hard into last week. Now we're consolidating. It's doing exactly what it should be doing right now. Now, what Dave talked about earlier was saying, should we not be selling off or something like that? It can sell off when you're in exhaustion like this.
Though.
Right. But here's the thing. So what we can do is we can apply some context to this. If the price stays above 4,500, or if it stays in what we call this high and tight flag, that's very, very bullish. And I would expect as a result of that to see it break higher from there. If it continues to stay in a very high and tight flag, and if we see the energy go back up again. However, there's no requirement for it to do that. So if it falls out through the bottom of this, if it falls out through 4,500, especially if it comes down really deep and starts to fill those gaps there, then that implies that any bounce from here is going to be a lower high, and probably we will roll over a little bit more, and that could imply a weekly lower high. So you can see how we're at a really important point here with the charts, whether or not we're going to go higher or lower into the month of September. Now, we had talked about 4,300 being a lock to get tested. That never happened. So also what happened is the weekly chart is, for all intents and purposes, charged up. It is ready to go on a mission, either higher or lower. And so this is why we're watching here to understand whether or not we're going to get a move to the upside or to the downside. Rule number 2 of fractal energy trading is that reversals start from the inside out. So we're watching those smaller time frames, and we'll see whether or not we're going to break higher or lower.
I'll tell you what, Doc, I told my students this weekend is like we are in one of those kind of time periods where with the weekly where it's at and everything else, I think by probably, let's call it the third week, the Fed week of September, I think that's when we're going to see the weekly start to tell us which way it's going to go. And there is no point to step in front of a freight train. When the weekly goes, it can go for 10, 12 weeks in a direction, right?
Yeah.
So like I've told everybody, like, we've had a great year. We had a few trouble trades at hundreds, right? Everything's gone really well. Profitability has been really good. I'm going to risk off over the next few weeks. I'm going to do, half position sizing and everything else, and just let this thing kind of tell us which way it's going to go, and then take advantage through the end of the year, because it's going to take us that whichever way it does go, that's going to go through most of the fourth quarter into the end of the year. So it's like, don't be in a hurry right now to slap on trades or anything like that. This is a great time to be patient and get ready for which way this tells us it's going to go, and then take advantage, because it is definitely it's definitely at a point where we can go either way. There's enough bad news out there to take this thing down, right? And things that can happen. But there's also enough of the continue the party, at least for a little bit longer before we pull the rug out there too. So it's kind of a really important inflection point for the market for the rest of the year. And it's going to come to a head here in September. So be careful out there.
Yeah, this is why I love the new the campaign diagonals that we're using right now, because we get a chance to reset every single day. Every single day we reset based on what the market is doing. So we don't really, this has always been the problem that we've had with some of these big monolithic trades, is that you put up your goalposts and you're like, okay, all right, you two, now stay in the middle of the field. And it rarely works out like that. So markets, are going to move as far as they can, and they often quite do. And so you end up doing defensive moves, and you have to do all this kind of Aikido moves and gymnastics and bending over backwards. And, and it's stressful. It can be difficult because, again, you're trying to figure out, okay, what's going to happen in the future. And you don't really know. At the end of the day, you don't really know. So what I love about these trades is, like, every day I get a chance to reset this thing. Like, I don't care what happened yesterday.
They self-defend really well too. I mean, if you get if this weekly breaks out downward, the long put that we have just self-defends and gets super profitable, and allows you to exit and even restart the next one, and just continue to keep up with it. If it goes skyrocketing higher, well, you keep winning anyways, right? So it's it's a nice type of trade for an environment like this, especially with a big weekly move on that.
You know what I'm learning about today, and I know this, but it's a different deal when you see it in person. Like I'm selling an option, a 1-day option, and let's say that 1-day option's at 451. I'm selling so much extrinsic time value that even if the price goes lower down to 450,
it still can be profitable.
It's still profitable because there's so much fluff right there. And this is such a great lesson for people to understand that you don't have to like, oh my God, it's profitable by 10 cents. Let's take it off right now. No, you can squeeze that thing. You can take that lemon and squeeze everything you can out of it until basically all the extrinsic values out of that. And then you can say, all right, I'm done with you. I'm going to move you down in price, which is what we did today. And it's like, wow, talk about non-stressful. And it's like, it's so mechanical. It's so non-stressful. It's like, this is, I've tried this strategy before, through the years, but I never got it to work very well because the market always moved too much. So when I was doing it once a week, it was like, oh, weekly options, great, but it still moves too much in the course of a week. So over the course of a week, your long put may have, just completely crushed in value. You won your short put, but big deal, your long put's getting destroyed. And now I get a chance to reset it every day. Or
that's what daily options have done. And that's why things have changed in the way the market price action moves, because, obviously we're not the only ones doing that, right? And that's it fits with the world that we're in now, in the sense that I say in my podcast all the time, we live in this instant society, right? We stopped the microwave with 3 seconds left. We can't wait 3 seconds anymore, right? Our attention span's out of a gnat. And so it ends up being like most people gravitate to that very, very short-term trading. And that's why you have these markets that literally, every day you're getting massive movement in the options and everything. And that just changes the whole way that markets move. When it was weekly, that changed it from when it was monthly, and so on, right? And so we just keep slowly getting down. I can't wait till the half-day options show up, or we start trading 24/7, because that's going to happen next. Hourly options.
I actually was trading intraday options about 10 years ago when binary options first came out. They were traded on, and they may still be there. It's a company called nadex.com. So it was his own exchange, and the spreads were terrible, but it's like, okay, here's a 10 o'clock option. Here's a 2 o'clock. Here's a 4 o'clock.
Right.
And it was tough, because the spreads were
supposed to go mainstream,
they're in all they will. I'm convinced that they will, because if the CBOE determines that there's money to be made, and if people want to hedge intraday, it will happen. But I think before that happens, I think what we will see is true 24/7, because the crypto market has already gone down that road 10 years ago. Right. Crypto has been 24/7 basically since day one, and most of the commercial trading has been happening over the last 10 years. So that's what everybody's growing up with. All these kids are coming up, trading crypto and eventually migrating over to the big boy markets. And they say, well, what the hell is this? It's shutting down on Friday afternoon. It doesn't open up until Sunday night. This is nuts. How can you hedge against yourself over the weekend anymore? And now we're seeing more and more things happen over the weekend where, somebody's bombing somebody else or whatever. And it's, we have to have 24/7 markets, and it will happen at some point. So what this also drives us towards, and this is why I get excited about strategies like this, is that I can get a little robot to trade this thing for me.
Yeah, exactly.
Because there's nothing magic that I'm doing. There's no magic sauce that I'm sprinkling on it. It's more of determining how you're going to handle things and not panicking at every given second, right? Because you have a bigger term, you have a bigger picture of what's going on.
Well, and you're doing it every day. It's very robotic, transactional. It doesn't require finesse, right? Some trades require the ability to finesse and, that sort of thing, right? Selling short-term spreads right now requires finesse, right? Which is why I'm not doing it. If I'm, selling like, weekly credit spreads right now, in the span of a week, you can get hit on both sides, right? So you got to be able to finesse it, right? So that's more like you have to play the swings. Like if you get the big move in the game of the week, at the upside, you sell the top side. Then you're patient, you let it fall, and then you sell the bottom side. You play the swings like that. And that's not something that's really conducive to like a service, like a newsletter and stuff that I put out. I'd be sending alerts, 3 times a day, right, to students. Like, so it just doesn't make sense to trade that right now. But we'll get back into a time where it does. And that's the nice thing about these is we have different strategies for different things. And so, so that's one of the reasons that I do like, this diagonal strategy, because it's very, very just like water dripping on a rock every day. Here's your rules, here's what you do, and you just follow it. And it's pretty easy.
The challenge with this, Dave, is actually making it simple. Because I mean, there was people in our
people want it to be more complex,
right? There were. I mean, we've spent the last 6 months, myself and other members of the mastermind community at 12-Minute Trading. We've been, heads down, hunkered down, like just casting a wide net across the trading community. It's like, because we knew that with the volatility compression, we needed to be doing time spreads, because that is a fundamental edge where the shorter term option will decay faster than the longer term option. And so that's a fundamental edge that we have to take advantage of when you have low volatility. There's no question, you have to do it. But everything that we've looked at, it's like, okay, should we do diagonals and calendar spreads and this and that and everything? And what we found is like, there's so much variability. So even though it's a simple trade, there's so much variability. So trying to come up with a static, what I call a discrete trade. Like you enter, you exit later on, and you hope you make money during that trade. So that's what I call a very discrete trade. And that's what most of us are trading. A campaign trade is very different though. Think about a campaign trade as something like owning a stock and doing covered calls against it. That is a campaign. It never ends, right? You hope that campaign goes off into perpetuity, that you're always writing. And some people do that. Some people get gifted stock and then they can't let it ever get called away, because that would be a taxable event that they don't want. So they run a campaign against it. This is exactly the same thing. And it takes all the pressure off. And it's so funny because a lot of students are like, what should we do about this trade? They get all keyed up on any one trade. And it's like, slow down, calm down. It doesn't matter. It doesn't matter. It doesn't matter if we get out for a profit on this one, because that'll, profit or loss. It doesn't matter as long as we wring everything out of this thing. And then that sets us up for the next trade. So I love this thing. I'm really super pumped for our students on this, and I think it's going to make a big difference.
Yeah. And it's just, again, it's a different mindset, but it's much, much easier and honestly less stressful in that sense too. For those that, if you're selling closer to the money and trying to extract premium value, like even on a daily or weekly basis with selling options, this is definitely the way to go. Longer term is still pretty good. We don't have such big issues doing the longer term stuff. But
Batman doesn't just have one tool on his belt; he's got several.
Right. But yeah, so I mean that's kind of where we're at going into this week. I'll be interested to see how we end this week. Honestly, I think that it's going to take another decent move down to get that weekly charged up a little bit more. I'd like to see it upwards of 60. You look at the 9-day time frame. I look at the 14-day time frame. So I've got a little bit more to go on the 14-day time frame. The 9 is rolling over a little bit, but we've seen these things like roll over and then go back up and do that stuff before. So I think we just have a little bit more time. And I think it's after last week's kind of move on low volume, I wouldn't be surprised to see some profit taking on that this week. Sell off a little bit, and nothing huge. Maybe down in the mid to lower 4,400s, like on the S&P. Walk sideways a little bit, and then from there it's going to make the decision. Does it go running higher through the next couple months, or does it just give it up from there, right? And that's kind of why I said it's time to just sit back and let this thing tell you which way it's going to go, and then take advantage.
Hey, and by the way, there's several of us out there watching this live today, so welcome aboard. And if you guys have any questions, please let us know. We've got another 5 or 6 minutes before we have a hard stop at the bottom of the hour. Or if you're watching this on a replay, which is probably what most of you will be doing, we're welcome to, or we're certainly happy to take questions through email, and we can bring them up next week, which will probably be next Monday. So if
support at 12minutetrading.com, just send them in to us, or even put them here on the channel. We can see them there too.
Right. We can do that. So, yeah, interesting week. It could be a real zero of a week. That's sort of what I'm hoping for. That the market, this is the Fed's last shot to get their Fed speak in before they go quiet for 2 weeks, which is going to be blessed silence. And there's going to be very few. I've always found this is like the first half of September is just like it's like the market is asleep. It's the back half of September where everything happens, where all of a sudden everybody goes, okay, let's get ready for the fourth quarter. And that could be either direction. We don't know.
Yeah, like we saw that last year, right? The correction started in September, went to October where he got the bottom, and then it bottomed in October. It's definitely it's that type of month. In perfectly positioned, the Fed meetings third week of the month. When I haven't looked, but I'm sure we have inflation data and all that coming out ahead of the Fed, so that'll help with that. But I wouldn't be surprised to see them pause this month. I mean, I think it's pretty much baked in that they're going to pause.
Yeah, it's like it's inflation 90%.
Yeah, inflation is going back up though, and so it went up. Through July and August. And the biggest reason is oil's up 30%. We just talked about oil being up $87 a barrel. It's headed towards 90. OPEC just said they were going to keep the cut of 1 million barrels in place through the end of the year now, today. So I think that's going to continue, and you're going to start to see that, because we got some of it in July, but we got a full month of August now. We're going to have a full month in September. So don't be surprised if you see inflation start ticking back up. I don't think it's going to tick up enough to make the Fed change their mind for this meeting, but it may for the one following.
So, Dave, I wonder if this is going to happen. So, all the reasons that you mentioned, where you got oil ticking up, everybody looks at inflation, so interest rates are going to go up. Maybe the Fed just sits back and lets the whole thing go up by itself, right? They don't have to raise rates; they can let the bond market do the heavy lifting for them. Until such point that, so they can point the finger at the bond market for making everything, blow up down the road instead of the Fed upsetting,
blowing it up,
the apple cart. So
it is the Fed. It's going to be the Fed's fault. Always remember, the Fed is late to act and they always stay too long.
They always stay way too long.
They've gone really far. They've gone the farthest, the fastest in history now. And I think, people are like, oh, the soft landing looks like it's a reality. That's what they say right before the hard landing comes. And so I just don't think you can do what the Fed did and not have a significant impact. In fact, So I keep saying I think it has to come from the credit markets. If the long end of the curve, let's say those 10 years and the longer end of the curves really starts to go up, and think about why that would happen, right? We've got Japan, who their yields are going up, and they're the largest holder of U.S. bonds and treasuries, right? And so they're sitting there going, okay, we've got to sell some of these to buy our own bonds to keep a contagion from happening in our market. So they got to dump. China's already at the lowest they've been in 20 years, right? And so they've got their own problems in their economy. And then we're sitting there running $1.5–2 trillion deficits, and we're not even in a recession or anything else, right? So this is just a recipe for, at some point, people to say, if you want me to give you money for 10 years, you got to pay me more than 4%. You got to pay me 5 or 6, or I'm not gonna why would I take that risk? You're 33 trillion in debt. You're adding trillions of dollars a year to that debt, and it continues to grow. And you want me to lock my money up for 10 years with you? I want a better return, right? Now, the U.S. is kind of, again, reserve currency, dog with the least fleas, but still think about it in your own personal life. If you were going to lend money to somebody that was $1 billion in debt and made $100 million a year, right? Like put it in perspective, right?
Yeah.
Or $1 million in debt and made $100,000 a year, and they wanted to borrow money from you. Wouldn't you want a good return on that? Right, a higher return than 4 or 5% on the short end of the curve. You want more than what the short end's giving you for locking your money up that long. I think that's what has to break. That's what I'm looking for. So, and it'll come out of nowhere, and then that's what will really cause the bigger issues to happen. And you got to already, you got the real estate markets to watch, because we're at 7.5% mortgages. If the long end goes up, those mortgages are going up to 8, 9, 10%, right? So,
bye housing market.
Yeah. So that's why, like I said, there's a lot of things that can make this thing just go take this weekly swing down, right? But, there's kind of the way the markets work, that last kind of run higher before we give up the ghost type thing.
Right.
So.
Yeah, my first house was 10%. I bought it at 10%, but it was cheap. That's the biggest difference today is we're going to have.
That's the crazy thing.
Yeah.
Yeah. You can have high interest rates, lower prices. You can have higher prices, low interest rates, but you can't have high prices and high interest rates.
Right.
It's going to break.
It is. Yeah.
Right.
So it's going to pop.
Yeah.
My daughter is she's about to get married, and they're looking for a house, and they just can't swing it, and they're going to have to wait for the bubble to pop, unfortunately.
Yep.
So.
Yep.
Meanwhile, I'm in at 2.9%. I'm never leaving.
Well, that's 38 or 40% of total mortgages are either in that or paid off. So now you know why it's just like nothing's budging. But it will
frozen.
As time goes on, eventually people have to move. Things happen, and that's when it starts to break down.
Meanwhile, Home Depot is doing great.
Take longer.
Yeah.
Yeah, they always take longer. I mean, you remember 2008? That was like 4 years coming, before that all went down and stuff. So true. Things always take longer. But yeah.
Okay, guys. Well, thanks everybody. It looks like no questions for today, so we want to thank you guys for joining us, and we hope that you join us next week. Same bat time, same bat channel. Actually, different bat time. We're going to be doing Monday is probably pretty normal.
Monday, yeah.
Yeah, this feels like a Monday though, unfortunately. But so thanks everybody. We will see you next week, and everybody be good out there.
Bye, guys.